economic data coming out of the US of late has been decent. However, I spoke to Haig Bathgate, joint CEO of investment management firm Tcam, about whether or not the Brexit could derail the US recovery, anticipated interest rate hikes by the Federal Reserve, and the US dollar strength.
I don't think so. Our view is that this is a very short-term impact. Clearly what it's done is it's pushed out expectations of interest rates being increased and has pushed out the likelihood of them being increased. We saw the Federal Reserve taking into consideration what was going on with China, and they've also referenced what's happened in Europe with Brexit. So certainly it's pushed out the prospect of interest rates increasing, but I think it's going to be a short-lived impact, and it's going to be purely related to sentiment. What happens in the UK or within Europe to a greater or lesser extent is not going to have really any meaningful impact on the US economy.
Now, Janet Yellen did seem quite upbeat in July's FOMC meeting. Do you think that the market could be pricing in a rate hike before the end of the year?
Yeah, I think so. Our view is that definitely the impact of the Brexit has pushed out the prospect of an interest rate increase, but we think that the market is complacent about when that first rate increase will happen. We think it will happen certainly before the end of this year, and there could be 2 consecutive rate rises in quite short order. The one thing that we have seen in the US and with the Federal Reserve is they're not scared to change their mind if the facts change. We saw that with the taper tantrum a couple of years ago, and they will change their mind, and they don't really care about losing face. And I think that could happen quite quickly. It will emanate likely from wage growth. Wage growth doesn't feature in the official measure of inflation, but has a second order impact. So we think that the prospect of rate increases in the US will be before what the market is expecting at the moment.
You were saying that we could get rate hikes before the market is actually currently expecting. What do you think then in terms of factors could force the Fed's hands?
I think it will be inflation coming through. So they've made it quite clear, and if you read the statements that they release, if inflation comes through, and it's not cost push inflation from imports, it's actually demand pull inflation, which should be driven through wage increases. That's where they'll increase rates, and we've seen this historically as well, that the Fed will react in quite a meaningful fashion if they see inflation come into the system.
What about the US dollar then? How far can it rally against sterling, and what would this mean for inflation, as you were saying?
Yeah, well, we think, and we've seen this historically as well in the aftermath of the credit crisis. The currency impact tends to go on much longer than people think. If you remember, we got down close to parity against the euro in the aftermath of the credit crisis in 2009. So we think it could go down to about 120 against the dollar, but then we think it would start to rebound thereafter. Certainly, we're starting to look at reducing our hedges and our negative position on sterling and more positive position on the dollar.